Hi everyone! Today, we're going to learn how to calculate the value of a stock using the Zero Growth Dividend Discount Model, or DDM. This model is a straightforward way to estimate the intrinsic value of a stock, and trust me, once you see how it works, you'll feel confident tackling any similar problem in the future. And remember, it's okay if this is your first time seeing it, by the end of this you'll be a pro. Let's dive in! So what is the Zero Growth Dividend Discount Model? It's a valuation method used for stocks that pay a consistent dividend without expecting future growth. This is useful for valuing stocks of mature companies that have stable dividend policies, like utility companies. The formula is simple and elegant. The value of the stock is equal to the expected annual dividend divided by the required rate of return. Let's break that down. Expected annual dividend, D1. This is the dividend expected to be paid in the next year. Required rate of return, R. This is the return you expect based on the stock's risk profile, which we often calculate using KPM. Now let's go through an example so you can see it in action. Imagine we're looking at a company called Steady Power Company, a reliable utility company that has been paying the same dividend for years. Here's what we know. The expected dividend for next year, D1, is $4.50. The required rate of return, R, calculated using CAPM, is 9%. Show slide, inputs for calculation. So we have expected dividend, D1, $4.50. Required rate of return, R, 9%. Now let's plug these numbers into the formula. The value of the stock equals $4.50 divided by 9%. Converting 9% to decimal form gives us 0.09, so value of the stock equals $4.50 divided by 0.09. When we do the division, value of the stock equals $50. So, according to the Zero Growth Dividend Discount Model, the intrinsic value of Steady Power's stock is $50. If the market price of the stock is below this, it could be considered undervalued and potentially a good buy. If it's above $50, it might be overvalued. See how simple that was? You now have a practical tool to assess stocks that pay steady dividends. And remember, this is just one of many models you can use to value stocks, but it's a powerful one when dealing with stable, dividend-paying companies. Great job following along, you've got this!